I'm going to focus on the United States in this video only because they're the world reserve currency. But everything in this video affects all of us because central banks around the world are all doing the same thing. With that being said, let's begin. Around the world today, we see central banks printing money. Here's a question. We are told from a young age that money is hard to come by and that we must study and work our whole lives to earn it. So how can all this money suddenly come from nowhere? How is money created? Who's going to pay it back? What exactly does all of this mean? And what's going to happen next? In this episode, we'll explore the 3 ways money is created and the consequences that come with it. I'll also show you the true origins of wealth inequality. If you watch this episode the whole way through, you should have a well-rounded idea of what's really going on today. It's important for people to know I'm really just trying to help with that. This journey starts off simple enough, but by the end, you'll start to see the insanity of what we're dealing with. The first form of money is the one created by governments. In practice, it's outsourced to central banks or the Royal Mint, but controlled by the government. Physical money comes in 2 forms, either paper money or coins. This physical money is a tiny fraction of the economy. In many economies, physical money only makes up about 3% to 8% of all money. Physical money is created to meet the obligations of private banks. When you go to an ATM and try to withdraw cash, banks need to make sure they have enough to meet your demand. Let's take a $10 note, for example. It costs approximately 3 cents to print. This means there's approximately $9.97 of profit for creating that $10 note. This $9.97 goes to the government. This revenue is called seigniorage. Since the government makes a profit from printing and minting coins, they can reduce the amount of taxation on the public. You might be thinking, why don't governments just print physical money all the time? The main reason is politicians. If a politician could create money at will, there would be a massive conflict of interest. They would be tempted to keep printing money to fulfill campaign promises or fund wars. This would eventually destroy the currency by excessive printing, causing massive devaluation. The more money you have in circulation, the less it's worth. And that's a key point. For example, if massive inflation takes place and the average person has $1 million, but that $1 million only buys an apple, how much is $1 million really worth? The loss in purchasing power of money over time is called inflation. When inflation gets out of hand, money becomes worthless. Some recent examples of runaway inflation include Argentina, Zimbabwe, and Venezuela. In Venezuela, for example, people started using money to make handbags or draw pictures because it simply wasn't worth anything anymore. You can think of money as a measuring stick of value, a measuring stick that is highly elastic and can change depending on how much money exists. For thousands of years, gold was the measuring stick of value. Gold was like a physical anchor, keeping the money supply in check and governments responsible. In 1971, President Richard Nixon announced that the United States would no longer convert dollars to gold at a fixed value. Since that point, money, the measuring stick of value, became elastic. Since the U.S. dollar backs all other currencies as a reserve currency, Nixon's decision changed the world. You might still notice that despite politicians supposedly not being able to directly influence money creation, it's happening anyway. This may cause problems, as we'll see later in the episode. So to recap, the government creates physical money, notes and coins. Only about 3% to 8% of money is made this way. Seigniorage is the income made from creating physical money. It helps reduce government debt and reduces tax burdens on individuals. Governments don't print more physical money because of the inflation risk tied to politicians' decisions. Now let's move on to number 2, private banks and debt-based money. The vast amount of money today is created by the private banking sector. In most developed economies, about 97% of the entire money supply is created digitally by banks. Most money in the world today is privatized. Banks invented digital money when they persuaded lawmakers, after many early bank runs, to allow them to create more deposits than actually exist based on debt. A bank run is when depositors rush to withdraw all their money at once, but the banks don't have it. From these events, banks argued that they should be legally allowed to create more money through loans, even though it's just numbers on a screen. The idea of using debt as money actually begins much earlier. In 1704, the English Parliament passed the Promissory Notes Act. What you are seeing here is a promissory note, a written promise to pay back money borrowed. Under the law, this piece of paper was as good as real money. Today we digitize these agreements and call it debt. If it helps, whenever I say debt in this episode, think of this promissory note, a written promise that you owe something. When you walk into a bank and take out a $500,000 mortgage, the bank doesn't hand you money from a vault or from someone else's savings. Instead, it simply creates that money out of thin air, digitally typing it into existence on a computer screen. With a few keystrokes, you suddenly owe the bank $500,000 plus years of interest, and that newly created debt money now flows into the broader economy. The person selling the house receives that digital cash and can immediately use it to purchase cars, pay bills, invest, or buy other assets. It's money born from your debt, circulating like real wealth. In today's financial system, economic growth depends directly on expanding debt. Debt is no longer just a burden, it is the fuel of modern economies. To the lender, usually a bank, debt is an asset that promises future cash flow. To the borrower, a homeowner, a business, or a student, debt is a liability that demands repayment. But here's the twist. Banks don't move old money around when they issue a loan. They create brand new money on the spot by typing numbers into their balance sheets. Your promise to pay becomes the foundation for new economic activity. Banks thrive not by lending out savings, but by charging interest on the digital money they create. When you slowly repay your loan over the years, the original debt disappears back into nothingness, but the interest you paid remains firmly in the bank's pocket. In this way, banks harvest wealth from the real economy without ever risking much of their own. Of all the avenues for creating debt money, real estate is the king. Banks love issuing mortgages because they are backed by tangible property. If you default, the bank doesn't lose. They simply seize your house and sell it again. In countries like Australia, banks have shifted overwhelmingly toward housing finance, abandoning small business lending almost entirely. This over-reliance on property debt has artificially inflated housing prices, creating dangerous property bubbles that make homeownership almost unreachable for the next generation. As a society, we have become addicted to debt, the way a patient becomes dependent on a life support machine. Individuals, families, and entire economies now run on ever-growing mountains of borrowing. Household debt levels have exploded to historic highs, surpassing even the debt burdens seen in infamous economic disasters elsewhere. It's a dangerous game of borrowing against the future to maintain today's lifestyle. When you deposit your hard-earned money into a bank, something surprising happens. You give up legal ownership of that money. Legally, your deposit becomes the bank's property. They promise to give you an equivalent amount if you ask, but in the meantime, they only keep a tiny fraction of it, maybe 10%, and lend out the rest. This is known as fractional reserve banking, where your $100 deposit can trigger the creation of up to $1,000 in loans and new money as it ripples through the economy. Since March 26, 2020, the rules of the game changed forever. The U.S. Federal Reserve eliminated the reserve requirement, allowing banks to create unlimited amounts of digital money without holding any physical reserves whatsoever. In other words, banks can now lend as much as they like, constrained only by their own appetite for risk. Banks don't just make safe, traditional loans anymore. They also gamble wildly with customer deposits, investing in high-risk ventures like derivatives, stock markets, and even exotic bets like weather futures. Many of these derivative bets are so complicated that even senior bankers barely understand them. This reckless gambling played a huge role in causing the 2008 global financial crisis, when entire financial giants collapsed under the weight of their own risky bets. Today, the derivatives market is a vast, hidden ocean of financial contracts, so huge that nobody can measure it precisely. Some estimates suggest it exceeds 1 quadrillion, an amount greater than 10 times the entire world's GDP. It's a towering house of cards, delicately balanced and frighteningly unstable. The cycle repeats. During booms, cheap debt floods the economy, encouraging people to spend, speculate, and take massive risks. Asset prices soar, people feel rich, until they reach the limits of debt. Defaults then rise, panic sets in, and the economy collapses into recession. The same debt that fueled the boom becomes the anchor that drags everything down. In 2008, it became clear that banks had become too massive, too interconnected, and too fragile to fail without triggering a global collapse. Governments and central banks rushed to bail them out, using trillions of dollars of emergency funds. But something crucial changed. Since then, the real economy, the world of hard work, production, and savings, has been artificially sustained by central bank money printing. It's no longer organic growth, it's growth hooked to a financial IV drip. Today's financial world is built on a new unspoken rule: private profits, public bailouts. When banks and big investors take risks and win, they keep the profits. When they lose, central banks flood the markets with newly created money to prop them up. Interest rates are artificially suppressed near zero, warping the prices of everything from stocks to houses. Free money for banks and endless risk for everyone else. At the click of a button, banks can type numbers into a computer and, almost like magic, create money. Through a legal structure, consumer deposits, once entrusted to the bank, are no longer technically yours. They belong to the bank. Banks can spend, lend, and even gamble with that money to a certain extent. This system operates under the doctrine of too big to fail, meaning that large banks are insulated by the comforting safety net of central banks. This arrangement creates a moral hazard, a world where reckless financial behavior is encouraged because the backstop of government support is always assumed. And now we arrive at the final, and perhaps most insane, form of money creation: central bank digital money. This third form is called quantitative easing, QE, a relatively new concept first pioneered by the Japanese central bank in 1989. It exploded into global consciousness when the U.S. Federal Reserve unleashed it during the 2008 financial crisis. QE works like this. The central bank creates money out of nothing and uses it to issue loans directly to the banking sector, massive corporations, and even more recently, directly to the public. It's a desperate flood of cash into the economy during moments of extreme collapse, like the 2008 meltdown. This unprecedented practice sent central bank balance sheets into uncharted territory, bloating them beyond anything seen in modern economic history. It was a desperate act to prop up a crumbling economy, but it came with serious consequences. In 2008, America faced its moment of reckoning. For the first time outside of Japan, QE was deployed with shocking force. A $700 billion bailout was approved amidst national uproar. The U.S. president defended the controversial move with a simple yet chilling logic: bailing out Wall Street is the only way to save Main Street. Behind the scenes, Treasury officials and Congress scrambled through frantic weekend sessions, hammering out a deal to let the government buy mountains of bad loans and mostly toxic subprime mortgage securities. But here's the kicker. Those bad debts were dumped directly onto the American public's back. To make it possible, Congress had to raise the legal limit on the national debt from an already eye-watering $10.6 trillion to $11.3 trillion. Initially seen as a one-off emergency maneuver, QE soon became a permanent feature of global finance. The Pandora's box had been opened. It's staggering when you think about it. From America's founding in 1776 until 2008, more than 2 centuries, the U.S. accumulated less than $1 trillion in debt. Yet by 2014, just 6 years after the crisis, national debt had exploded to $4.4 trillion. The madness didn't stop there. When the COVID-19 pandemic struck, the U.S. created an additional $3 trillion in just 3 months. Today, central banks are capable of creating hundreds of billions of dollars within hours. And with each new batch of magic money, it seems to have less and less real-world effect. We are now operating on a financial system that is based almost entirely on faith. Faith in the U.S. dollar, faith in the government, and faith in the mysterious power of printing presses. As one commentator sarcastically put it, it's not real money, it's fake money, but we have faith in it. The uncomfortable question looms larger with every passing day. How long can this last? At what point does the taxpayer rebel, asking, if you can endlessly bail yourself out by printing money, why the hell am I paying taxes? This quiet anger, buried deep within the middle class, is the ticking time bomb of social unrest. You can only stretch the gap between the haves and the have-nots so far before it snaps. Here's how QE injects money into the economy. Central banks buy government bonds, which are basically just fancy IOUs, using money they conjure out of thin air. While the media loves to talk about the stock market, the bond market is even bigger, a hidden giant that truly controls the lifeblood of the financial system. This leads to an astonishing revelation. Central banks, which have no real savings, can never go bankrupt because they can always print more money. A European central bank paper in 2016 even admitted this outright. Central banks are protected from insolvency because of their power to create currency at will. It's like playing Monopoly where you own the bank and can print extra money anytime you want. Governments today are trapped. They owe trillions to central banks but can't raise taxes fast enough to cover the debt. The gamble is that the borrowed money will kickstart economic growth. But something even stranger is happening. When central banks buy bonds, they slowly begin to own the assets tied to those bonds. The Japanese central bank now owns 80% of Japan's stock market, making it the largest shareholder in the nation. Similarly, the Swiss central bank owns $90 billion in U.S. stocks, with major stakes in tech giants like Apple, Microsoft, Google, and Amazon. When I first learned about this a few years ago, I genuinely thought it had to be illegal. It wasn't. It is, in fact, completely legal. In a world addicted to endless money creation, the very institutions that were supposed to stabilize the system have become its largest and most powerful players. They created money from nothing, and they couldn't go bankrupt. But as they conjured cash out of thin air, they weren't helping everyday people. They were buying real assets. Even a toddler could tell something was terribly wrong. It turns out, creating endless money has consequences. Central banks pulled the stock market out of reality itself. In the 20th century, markets mirrored the economy, but now they're almost twice the size of the entire nation's GDP, a bloated monster fed by invisible hands. In April 2020, over 30 million Americans lost their jobs. Yet, unbelievably, the stock market had its best month since 1987. The central bank printed trillions, flooding banks and hedge funds with near zero interest cash. The real economy? It got almost nothing. People wondered, if they printed so much money, where was the inflation? It was hiding in soaring housing prices, in sky-high stock markets, The printed money went into assets, not into people's hands. The rich grew wealthier, while the poor were left to drift. Since the 1980s, the wealth of the upper class has been tied to the stock market. After 2008, it became glued to the Federal Reserve itself. The more they printed, the richer the elite became, wealth soaring by 420%. When money is printed, the first recipients, the powerful, enjoy it before inflation erodes its value. This is called the Cantillon effect. By the time it reaches ordinary people, it's worth far less. They pay the hidden price of the rich's luxury. Experts warn when the rich start selling off stocks and real estate during future crises, money velocity will explode, and then real inflation will strike. The quiet before the storm is ending. To recap, central banks have no savings. They can't go bankrupt. They create infinite money by buying government bonds, promises future citizens must repay through either taxation or inflation. So what could have been done? Instead of money printing, societies should have focused decades ago on true wealth creation, investing in entrepreneurs, manufacturing, innovation, education, and dreams. Imagine if banks had fueled the dreams of small businesses and innovators instead of gamblers and speculators. How different and beautiful our world could have been. The truth is, we poured billions into speculation, into gambling on stocks, property, and futures, instead of focusing on real wealth creation. Imagine if we had directed that money into building businesses, driving innovation, and creating jobs. The risks for banks might have been higher, yes, but the long-term rewards, higher living standards, more competition, stronger economies. Governments could have collected more taxes naturally from rising prosperity without raising rates, using that money to support those who needed it most. You can print money, but you can't print wealth. Building true wealth takes time, patience, sacrifice, and work. And today, it seems, few have the appetite for it. Frankly, it's too late now. If we had funded real productivity before COVID struck, our economies would have been resilient, much like in the late 20th century. Instead, now we face the consequences of a fragile, over-leveraged system. So, what happens next? In my view, we are heading into a storm, a decade of hardship, massive inflation, slow economic growth, widespread social instability. This isn't just a theory, it's something economists call stagflation. It crippled economies in the 1970s, and this time, with far more debt in the system, it could be worse. Some believe the world will lose faith in the U.S. dollar. Others argue the dollar will actually strengthen, at least temporarily, because it's the cleanest shirt in a pile of dirty laundry. This idea is known as the dollar milkshake theory. Some dream that stablecoins or cryptocurrencies could fix everything. Others swear by modern monetary theory, claiming governments can just print infinite money as long as they keep producing enough goods. But no one knows if these solutions will work. It's all untested and fragile. Interestingly, in places like small towns in Italy and communities in Venezuela, people are taking matters into their own hands, issuing their own local currencies, fighting back, one small step at a time. Here's the truth. We have no clear answers. We are walking into the unknown. But history tells us this. Out of the worst circumstances, the greatest innovations are born. So, what can you do? First, think for yourself. Do your own research. Many are turning toward assets that aren't debt-based as a form of insurance. Older generations are looking at gold, the money of last resort. Gold can't be printed by governments. It's a hard asset, something real. Even global powers like China and Russia have been stockpiling gold for years. They see what's coming. Younger generations, meanwhile, are drawn to cryptocurrencies, new decentralized forms of value exchange outside government control. And if you're daring, you could even play the central bank's game against them, investing in assets you believe will rise. But at the end of the day, no one can tell you what to do, not me, not anyone. You must make your own decisions. Because here's the most important truth. The monetary system, the banking system, all of it, has been invisible for so long we forgot to even question it. When cracks began to show, people blamed what they could see: capitalism, greedy companies, rich individuals. But the real problem lies deeper, in a system of debt, financialization, moral hazard, and a broken cycle of wealth. This isn't just an economic problem. It's a test of resilience, of courage, of innovation. The world as we know it is about to change, forever. And in that change, maybe, just maybe, a better world can be built, if we are brave enough to see it, and bold enough to create it.
Now you know, money isn't just printed. It's created through a complex system of debt, banks, and trust. Understanding this gives you the power to see the financial world differently. If you found value in this eye-opening journey, don't forget to hit the like button and subscribe to our channel, Money Root, where we break down the financial world in simple, powerful ways. Until next time, keep questioning, keep learning.